Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
Well, now to our most read story on the Bloomberg terminal in the last hour. SpaceX moving ahead with plans for an IPO that would seek to raise significantly more than $30 billion. People familiar with the matter said in a transaction that would make it the biggest listing of all time. That Bloomberg exclusive by Ed Ludlow and Eric Johnson. Eric Johnson is with us. He's Bloomberg News team leader for space, aviation, and defense. He's also global business of space editor. He joins us here in the Bloomberg Interactive Brokers studio, usually based in Seattle. We're lucky that you're here today in New York. Congratulations on this scoop. What did you and Ed find?
Well, basically, the SpaceX management and advisors are moving forward with plans for an IPO targeting next year, mid to late next year. Timing could slip to 2027, of course, as they go forward with these plans. But if they do, it would eclipse the 2019 record set by Saudi Aramco, raising more than, far above, significantly more than, according to some of the people, the $30 billion.
In previous years, Eric, we've talked about the idea of SpaceX potentially spinning off Starlink. Carol's been a longtime Starlink subscriber, fair to say, right?
Yeah.
Yeah, you've known the tech.
Cool.
It's really cool. I just experienced it for the first time recently.
Where do you use it, by the way?
On a boat.
Oh, very nice.
And it's
How does it work? Is it good?
It's fabulous.
Yeah.
And what's interesting, because you go to a lot of marinas and the Wi-Fi is not usually very, very good. And even though they try to create systems and so forth, it's incredible.
But you could stream us on YouTube. On Starlink.
Yeah. And it's just fascinating. You see the dish move as, it's pretty cool.
Yeah. So is the
service is great.
Is the iteration of SpaceX's IPO that you and Ed write about, does that include Starlink?
This is for the entire company.
Is there not talk about spinning it off anymore?
As you pointed out, over the years, SpaceX executives have talked about an IPO, and the idea is that as they become cash flow positive, they could spin off Starlink as its own IPO. It's more of a consumer tech play, but the plans have changed. And if you look at the growth of SpaceX, and you look at not just becoming the most prolific rocket launch company on Earth, but now they've got plans for their gigantic Starship, which is, they're developing to take humans back to the moon at some point, and eventually, if you believe Musk, Mars, we'll have a Mars colony at some point. But you think about that, and I shouldn't have laughed. And then you think about Starlink, which you brought up. I mean, now they've got millions of subscribers. They're operating the largest satellite network in low Earth orbit. So all of these factors are coming together to portray a company from a position of strength and growth. And look, Musk, so many people believe in Musk. He's got plenty of detractors, plenty of naysayers, but many people wouldn't want to bet against him. And you're seeing some of that momentum.
Well, when I think about Starlink too, I think, wait, is this going to replace our internet providers eventually for our home? How far can this go? And is that part of the plan here?
That's the key question. If you think about capacity. So for a while, Starlink wasn't good at operating in areas where there's fiber optic cable, for instance. They can't compete with that. It takes longer for data to move through space than cables.
Yeah.
But as they got more and more satellites, they're getting better and better. So you're starting to see their service improve. And one quick funny story, if you'll bear with me, is I was on an Alaska Airlines flight here, and Ben Minicucci, the CEO of Alaska, happened to be on the plane.
Nice.
And the internet was going in and out.
Of course it was.
And he comes rushing up the aisle and grabs one of the flight attendants and says, you reset it, and he's having this conversation. And then we happened to have Bloomberg and Ed board with him the next day at a conference. So I said to him, I relayed this, and I was like, listen, what were you thinking as this was going on? He goes, I can't wait for Starlink. And so they're one of their customers. So airlines are starting to bet on this. And
I've told this story 10 times already today.
Yeah, you've talked about this.
I took my first United flight with it last weekend, and it was totally game changing. And United's going to have it by the end of this year on all their small 2-cabin regional jets, so the smaller ones. But it was completely game changing. Eric, before we let you go, the other companies that compete in this space, Not in the delivering internet from space, but in the actual rocket launching, like a Rocket Lab USA, for example. How are they doing right now against SpaceX?
Well, our story sent their shares higher after the news of the IPO plans came out. But Rocket Lab is a formidable challenger. They're doing really well. There's companies like Firefly. There's a host of companies around the world that are trying to challenge Musk and try to rise up against SpaceX. But right now, they're the dominant player.
All right. Can I just say, though, I mean, $30 billion, $1.5 trillion, we're talking about a valuation. It could be even more, couldn't it? I mean,
could be a very good point. It could be even more. There's got to be. It's a long process. It's worth mentioning. They're in the beginning stages of this, and so you've got to do a roadshow. You've got to get the banks globally. You've got to get the banks involved, and absolutely, it could be significantly higher.
I think it's safe to say the banks are going to be clamoring for this, right? I mean, we haven't seen one of this size in a long time. All right. The understatement of the day.
The banks, the lawyers, the advisors.
Everybody.
Yeah, we're going to see the names.
What a piece.
We'll see the names associated.
Congratulations, a Bloomberg scoop. Really well done.
And to Ed Ludlow, too.
Both of you guys. Yeah. Killer.
Eric Johnson, Bloomberg News team leader for space, aviation, and defense. He's also the Global Business of Space editor. Sign up for that newsletter. You can do that at Bloomberg.com. Joining us here in the Bloomberg Interactive Brokers studio. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to now talk about the trade in multi-assets.
And to the head of multi-asset solutions at VanEck Funds, David Schassler joins us. VanEck has approximately $162 billion in assets under management. David joins us right here in New York City. The Fed decision, the commentary, in your view, what's going to affect the financial market trade the most?
We are thematic investors, so I'm going to talk big picture and then we can kind of narrow it down. So you've got three things happen, right? So think about it this way. You've got three basically mega themes crashing together at the same time, right? First one is clearly disruptive innovation. Yes, we're talking about AI, robotics, everything that, right? But in addition, you've got old world assets building new world, right? None of that happens without infrastructure development, raw assets, real assets. We're in a stealth bull market in real assets. And then third, we're in the debasement era, and that's going to lead to more liquidity. Now we're talking about, I know you guys were talking before this about rate cuts. Another 25 basis points, all moving towards and validating the thesis of the debasement era, where liquidity is going to get easier out of necessity. So that's where we think we're going, and it completely changes the landscape from an asset allocation perspective.
Okay, so what are I just talked to our team and asked them, Michael McKenzie, Stuart Paul, who watch the U.S. economy, they watch the rates market, kind of what they are queuing up for when it comes to Jay Powell tomorrow. They're going to watch what he says about the U.S. labor market. What is top of mind for you in terms of what could indeed impact the investment environment over the next 6 to 12 months? Or is it too early to even think about that, considering Jay Powell is likely to leave the Fed next year when his term is up and we get some new individuals on the U.S. Central Bank?
Yeah, so listen, Jay Powell, the attack of the central bank, their independence, him getting replaced, all that's happening, right? Who's he going to get replaced with? All that's happening, right? Now, the key is what's going to happen in the markets. AI, let's kind of go back to that because that's what's clearly going to drive markets. That's where the growth is, right? That's the focus. I think about AI in three phases. So that's how we frame it up. The first was the build. That's clearly where we spent the last 2 years, where anything attached to AI, billions of dollars in spend, all that was benefited. That's where the scarcity was. That's where the compute was. That's where the energy was. Then we moved to phase two. Investors are looking at it and saying, well, how do we get paid back? You spend billions of dollars. Well, how do we get ours? And that's when we start asking questions like that, there's going to be a disconnect between hype and expectations and the reality. Make no mistake about it. We're of the camp that AI is going to over deliver and that it's not underhyped long term. But there's going to be a mismatch, and that mismatch is going to cause volatility.
Well, what is the
volatility?
I just want to jump in because the over delivering on AI, I think the concern that a lot of people have is what's the fundamental change that it makes to our economy? The idea that workers should be very worried about their jobs, because that's the promise that AI has, an increase in productivity because this technology can do what human beings do. How do you look at that and the effect of that on the economy and the markets?
I think about it a little bit differently. So there's no doubt that there's going to be replacement, and the next few years are going to be particularly bizarre and uncomfortable for many, because where AI can replace, it's already replacing. So you see that in new college graduates. Anybody doing repetitive tasks where they're putting their head down and they're pushing computer keys, be concerned, think about expanding your skill set. At the end of the day, AI, which think about it as the brain, is going to combine with the body, which is robotics, to drive massive innovation, massive productivity gains, ultimately massive growth across the entire labor force. That's the setup. So you end up in a period of an abundance where you get better lives, higher quality of lives, longer lives, all that coming eventually. But the idea is really simple, is that human beings engage with this technology, as we have with every previous technological advancement as it relates to general purpose technologies, to make things better.
Well,
and that's the core assumption here.
So, David, the Mag 7, the Bloomberg Mag 7 total return index up 25% year to date, dropped more than 8% from late October to November 20th, and it's down about 2% since late October. The group has been definitely bouncing around as people question some of the spend by those hyperscalers that make up many of the names within the Mag 7. Is big tech, in your view, a buy, sell, or hold at this point?
It's a hold. And there's going to be more compelling opportunities as volatility is introduced, as people question the spend and the productivity payout. So in a very short period of time, unfortunately, I would say sell. But the reality is I would hold and buy into dips, because we're not entering this overexposed from our side. And that's the key, is not being overexposed. This technology cycle has long legs.
Yeah.
It's going to touch lots of things. It's going to require lots of old world assets. There's a stealth bull market going on in real assets right now as well. Natural resource equities are up more than the Qs this year.
Yeah.
People aren't talking about that.
Well, that's
how are we going to pay for this?
Well, 30 seconds. You have a favorite asset class. I mean, gold has soared this year. Bitcoin has bounced around. That's kind of the two extremes when you think about kind of the investment environment, with a lot of stuff, including private markets and everything in the middle of that. So favorite asset, just got about 25 seconds.
Bitcoin's a top performer by the end of the year, down 30%, mismatched off the Qs by about 50% this year. Followed by gold. Gold will hit $5,000, we think, sometime in 2026. Buy weakness in technology. We're in a long-term innovation cycle.
Cool stuff.
All right,
Fun to
we got
have
some
you.
calls. There it is. We'll have you back.
We will in 2026. David Schassler, head of multi-asset solutions over at Van Eck Funds, joining us. That was some cool stuff.
It was. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The countdown is on.
Yes.
T-minus 23 hours. That's when we'll know not just the decision, but also the summary of economic projections that will perhaps give us a good idea of the direction of travel for rates. We've got back with us Joyce Wong. She's Senior Client Portfolio Manager at American Century Investments. The firm has about $300 billion in assets under management. She joins us here in the Bloomberg Interactive Brokers studio. We think we know a lot about tomorrow. Like, one rate cut, 25 basis points. What do we not know?
Well, we don't know how Chairman Powell is going to message it, right? I think, it's been kind of volatile between the last 2 months with the government shutdown in between, that there was going to be a December rate cut. We always thought there was still going to be the December cut, but I think what's going to happen is that we've always been thinking there won't be as many cuts following this one. So in 2026, we think there could be as few as one additional cut after tomorrow. The market was kind of more 3, 4.
One all of next year?
Mm-hmm.
Yeah. I feel like we've been hearing folks saying that maybe the next one wouldn't come till maybe, is it May or later of next year?
So I think that's going to be the messaging
Yeah.
around this, is how Chairman Powell talks about this cut and when the next one will, if and when the next one will come.
Is the market prepared for that?
Well, that's why I think it's going to be interesting tomorrow. There have been more and more people joining our camp and saying that there's going to be fewer cuts next year than originally thought a few months ago. The reason we think that is because inflation still remains sticky.
Right.
We'll see. We are still going to get delayed data. We'll see how the holiday season plays out. But It looks like consumer confidence is staying stable. It's back up a little bit. People are still spending. I saw stats that this was like the best Black Friday in a long time. So it seems like inflationary pressures that we've seen are still there. So the Fed has to be very, very cautious in reducing much further.
Yeah, it's kind of fascinating. Right. We still have growth. We see softness in the labor market. I mean, is there, though, the nervousness that as we start to see things maybe slow down in some sectors of the labor market, Joyce, that all of a sudden it can start to kind of pick up some momentum and it get even worse? Because I do feel like we're increasingly seeing companies talk about AI and don't need as many workers, from companies who were like, before, nope, it's not going to be a problem. It does feel like that's picking up momentum as well.
Yes. And that's what I'm really curious to see how Chairman Powell messages that is if they do cut tomorrow, it's going to be because they are more concerned about the labor market than inflation. Because if it were the other way, they wouldn't cut.
Right.
So what we want to see is, we got the JOLTS data. Job openings are actually more than before, which was a surprise a little bit. But people are not leaving their current jobs and moving. People are job hugging, right? So there's not a lot of turnover. And so that's why a lot of these new jobs aren't being filled.
Just anecdotally, it's so funny you said. I was talking to somebody in the last few days who's pretty high up in tech. And I said, and he was telling me about his job. And I said, you must have headhunters just coming after you. And he's like, are you kidding me? I was like, what do you mean? He's like, the market is completely dead right now.
Wow.
Nobody is calling.
So companies kind of holding on to maybe who they have, trimming back and just saying, let's see where this...
And what's interesting...
Is it because of AI or what?
It is. I think it's a little bit because of AI. It's a little bit because of the economic uncertainty. What 2026 is going to be super interesting because we think it's going to be a bit of a slowdown going into the early part of the year. All these companies are still passing through tariffs. People are still unsure. And then the second half of the year, we actually think there's room for a reacceleration. So it could be that companies just want to see how much they can get done with what they have right now or who they have right now. And then if the economic picture does improve as we anticipate it might, they'll add in the middle of the year.
Inflation. I mean, it's like...
It's still an issue.
Is it?
It's still there.
Yeah.
I mean, honestly, people always ask me, what is the biggest risk to markets? And I always say inflation, because not that I think it's going up to 9%, even 5%, but we've made a lot of the progress on inflation that we're likely to see.
Yeah.
So when you look at core inflation, it's actually gone up a little bit. It's still 3%. And that's more than the Fed's target.
What would have been, in your view, if the tariffs wouldn't have been implemented in the way that they were implemented? How much of this is tariff induced is another way to ask the question.
It does seem like some of it is, but what actually is not tariff induced is services, right? So, for example, insurance. I just got my annual insurance renewal.
My condolences.
It's up, right? Substantially.
It always is.
More than 3%.
Yeah.
So, there's these underlying components of the basket that are going up that have nothing to do with tariffs. So the goods inflation is actually...
the insurance discussion is completely separate. I think that's it. They have power.
They do. They've got some power there because you have to have home insurance and auto insurance, right? So that's an example of a component that continues to increase. Healthcare costs.
Mm-hmm.
Yeah.
We know that that's a hot topic in Washington, right? Healthcare costs are probably going to increase.
Power costs, right? The power
energy,
grab.
right? So all of these factors that have nothing to do with goods are likely to stay high.
So we're talking with Joyce Wong. She's Senior Client Portfolio Manager at American Century Investments. They've got approximately $300 billion in assets under management. So what are you guys seeing in terms of flows across your platforms, in terms of where money's going, where money's coming out of?
So at year end, a lot of our clients are thinking about rebalancing, thinking about positioning for next year. I would say income is really the key story here. We're seeing a lot of interest in just locking in these really attractive bond yields. You're getting 5.5% up to 6% in some of these actively managed income-oriented funds that we offer. And people are pretty happy with that, especially if you're looking at cash potentially decreasing with every Fed cut.
What about munis?
For sure. Munis is definitely one of our more popular offerings right now. I would say, especially going into year end, people are taking advantage of munis rebounding and locking in some of those tax
Well, I do
benefits.
feel like the high yield savings account emails that I keep getting where it's like your rate is dropping, your rate is dropping, your rate is dropping. It
Like the
makes
Fed
me,
hasn't even cut yet.
well, exactly. And I feel like it just makes munis and other sort of high yield products more attractive for money that would traditionally be in a high yield savings account.
Yes, I think you saw a huge rush into money markets, high yield, everything in 22.
But those money markets still have trillions of dollars in them.
They
And if
do.
they're not earning yield, where do they go?
Right. So there's still a lot of people still in them. I think you're going to start to see that coming out, especially with this cut and into January as people rebalance, as they take a hard look at their statements. Oh, wait, I'm not getting 5% on cash anymore. I'm getting 3.5, 3.25, 3. It's going to leave.
So Joyce, on the equity side of things, I mean, I'm looking at the S&P 500 major industry groups. Communication services are up 33% year to date. Information technology up about 27%. Industrials are up 16%. Utilities are up 12.5%. Financials up 10%. And that's just year to date. We know that we've seen some big swings because of the tariff and trade policies. Where's money going when it comes to equity? And I haven't even talked about global equity. So I'm just curious where you're seeing money going in or going out on the equity side.
For sure. In equities, we have a number of products that are focused. I think all of those sectors have one thing in common too. That's kind of AI tech related.
Yes,
so
totally.
we are starting to see some focus in our strategies that have that more growth orientation in the U.S.
Money going in?
Yes, for sure. I think people are still buying into that story. And we're starting to see some flows coming into the contrarian trade. So the sectors that should do better coming out of these Fed cuts. So things like small caps.
Yeah.
Right. So that's another area. American Century is actually the 4th largest small cap manager out there. So we are starting to see a lot of small cap flows coming. So for people who are looking for something that isn't super overvalued, that's an idea.
Yeah, I feel like the Russell's up almost 14%, but it continues to kind of a little forward, a little back. It's been struggling. Always fun when you come in. Happy holidays. Hopefully we'll see you maybe before the end of the year again. That would be really lovely. Joyce Wong, she is Senior Client Portfolio Manager at American Century Investments, joining us right here in studio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to stay on the battle, though, for Warner Brothers Discovery to a fantastically written deep dive into the hostile takeover bid for the company by Paramount Skydance that is backed by banks, billionaires, and sovereign wealth funds with the goal of putting an end, I should say, torpedoing the deal that Netflix has put out there. So let's get to what is one of the most read stories on the Bloomberg. Sally Bakewell, I can't speak right now. I'm just going to point. Sally's here. She's Bloomberg News America's finance team leader. She's here in studio. The financing that's going in to make this happening, it's quite a list. And there's been some jockeying and maneuvering to kind of get the backing. Walk us through what's been going on behind the scenes.
There sure has been some jockeying and maneuvering. But what we have landed on now is a $54 billion bridge loan, which is coming from Bank of America, Citigroup, and Apollo, who are taking about $18 billion of that each. And there is also a big equity component of about $40.7 billion. Now, there are lots of interesting things to this. First of all, the whole of that equity is guaranteed by Larry Ellison, essentially, who is the Oracle founder, friend of Trump, and father of CEO David Ellison. Now, it's guaranteed by Ellison and by Redbird Capital Partners. And providing the actual equity are this host of names from, the Gulf region, including Saudi Arabia's Public Investment Fund, the Qatar Investment Authority, and an Abu Dhabi relatively new company called Limad, as well as Jared Kushner's Affinity Partners. So you have this dash of tech wealth. You have this longtime ally of Trump in Larry Ellison as well. You have a spot of family with Jared Kushner. And then you have some Middle East money. And of course, Trump has, fostered some really close ties with the region. So the financing is notable because of the proximity a lot of it has to the president.
This is also a media question, but you brought this up on the call, Carol, when Rupert Murdoch wanted to buy Fox News and the regulatory environment that he had to deal with as a foreigner who was owning a news asset or a broadcasting asset. Maybe it wasn't Fox News per se. Maybe it was the Fox Broadcasting Network. I want to make sure I get that right. And I'm wondering, Sally, and I mean, Hannah, feel free to jump in here too. If there's any sort of question about where this money comes from when it is with regard to owning these assets. Like, you know, we've had cable assets that have had Middle Eastern money before and news assets in the US that have had Middle Eastern money before. But would that mean that CNN could potentially be owned by sovereign wealth funds or partially rather?
Yeah, and talking about this with folks in the industry, you know, there is this sensitivity around the fact that this is a major news organization at play, that it could be money coming in from abroad. That's definitely something that shareholders are thinking about in looking at these deals.
Go ahead, Sally.
Well, this is the interesting thing about the financing, and some of the tweaking and the reworking of the financing stemmed from this foreign investor component. So they're originally in a proposal that was submitted on December 1st. So that was an earlier proposal. The most recent one was submitted December the 4th. A Chinese company, Tencent, was listed as providing $1 billion of equity. That is no more. And also in the most recent proposal, one of the points that was emphasized was how these Middle East funds they are foregoing governance rights. So they won't have board seats and so on. Apparently, there were no concerns expressed about that element, but I think the company is trying to ward off potential concerns emerging down the line.
What about the president's son-in-law, though? How much of a position is that? I mean, it's hard without getting political. But
didn't the president say yesterday he hadn't talked to him about it, and Jared Kushner is busy working on peace in Gaza?
Yes.
Yeah.
Okay, I just want to make sure.
Yeah, but I mean, okay, how much of that investment? How will he have a board seat? Like, I'm just curious, do we know how much we know about around that particular part of the investment?
I think the idea is that he will also forego these governance rights, i.e. not having a board seat. That is what the proposal said. And it's a kind of interesting playbook that's being developed here with Jared Kushner, because his affinity partners was also part of the consortium that agreed to buy Electronic Arts in September. And apparently he actually brokered the initial connection between the video game maker and the Saudi Arabia PIF, Public Investment Fund, and actually acted as a central figure in the talk. So it seems like he is a sort of pivotal figure in some of these deals.
I see all the names in here and I hear them coming from you, and I think to myself, this is a very complicated deal involving a lot of advisors and a lot of bankers. But is it a complicated deal, or is it a deal of this size would typically have this many moving parts? The debt side, the equity part, and on the equity part, the multiple geographies and the multiple entities? I
think that's a really good question, because what we're trying to now look into is this $54 billion debt package. Because the loan, this $54 billion bridge loan, is going to be guaranteed by Paramount's assets. Now, that's apparently quite weird in the market for a loan like this, a bridge loan like this. And a bridge loan is one of these things that you get, and then you bring in other banks to spread the risk. And once the acquisition is announced, after time, the loan is placed in sort of more permanent form of financing, like bonds. And so what we're trying to figure out now, well, the fact that it's backed by Paramount's assets is an effort to get investment grade ratings, as far as we can understand, because Paramount currently does not quite have an investment grade rating. So there's just interesting elements to how this financing is being put together that are definitely a bit striking and a bit unusual, and we're trying to dig into that more.
So more to be known.
Yes.
More to be known. Yeah, I just think it's kind of fascinating. Either of you can weigh in. Is this it, or are we anticipating higher offers or another round? And I'm just curious, Sally, what you guys are hearing.
Ooh. I think I might have to punt that one to Hannah.
Hannah, are you hearing anything?
We know that this may not be a final offer, and they've left that open. Paramount has left that open. Warner Brothers has 10 days to respond, 10 business days.
Okay, so we'll see what happens. We know Comcast is out, though, at least for the moment.
I mean, yes, we heard comments yesterday publicly at a conference.
I mean, I'm not a conspiracy theorist, Carol, but if
you
you're
play
Netflix,
one sometimes
if you're Netflix, like, and you don't get the assets, you want you're the next bidder to pay as much as possible.
Yeah.
So it ends up costing them that much more.
Right, exactly. It just there's twists and turns to this one, and I feel like we're not quite done yet. So I know this may go into the new year. Thank you both for helping us understand this as we go, because there's a lot there.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.